Hey, welcome to the channel or welcome back to the channel. My name is Adrian. I'm a local realtor here in West Michigan. Today we're going to be talking about some tips for buying a home in 2023. Now before we get into it, make sure you hit that like and subscribe button and tap that notification bell so you don't miss out on any videos that I put out every week telling you everything you need to know about buying a home in West Michigan. Let's get into it. Now, before I jump in, again, my name is Adrian Valdez. Here's my contact info popping up here on the screen. I'm the one responding to all those emails, text messages, and phone calls, so feel free to reach out to me. I'd be happy to help you out. So one thing that I run into often when people are first looking at buying a home is finding out if they qualify as a first-time home buyer. This is important because it gives you different incentive programs as far as a lower down payment and a lower interest rate. Now, if you have not owned a home or had a home in your name in the last 3 years, you qualify as a first-time home buyer. So if that is the case, make sure you're taking advantage when speaking to your lender. Make sure they understand that you are a first-time home buyer or that you have not owned a home in 3 years. That way you can take advantage of the 3% down conventional loan and other programs like down payment assistance. For instance, here in the city of Muskegon, you could get anywhere from $1,000 to $5,000 in down payment assistance as long as you meet whatever income thresholds they have. Now, another thing with finance is going to be your pre-approval. Now, I'm not going to say you have to get your pre-approval before seeing homes because oftentimes you need to look around and get an idea of what you're comfortable with. But one big thing is don't use that pre-approval amount that you wind up getting as your price guideline. Make sure that when you're looking at it, you understand that they're approving you based on almost 50% of your gross monthly income. One good way to make sure that you don't have money for anything else in life is going to be taking that and maxing it out. Now, it could be a different situation if you're applying for the loan by yourself and you have a significant other or family member who's going to be living with you that's going to split that cost of that home. But if you make $4,000 a month and $2,000 of it is going to your mortgage, and then you still have to pay taxes on your income and any other bills that you have, you're going to have a very hard time making those payments or doing anything else. General rule of thumb that I use and has been general wisdom for quite a while is 1/3 of your income is what you should plan on using for your mortgage payment. Keep in mind any housing expenses that come with that. You're going to have your electrical, your gas, your water, sewer, if you're not on a well, which oftentimes out here you are, but then you still got to account for every 10, 20 years, you're going to have to get that well redug. You're going to have to get that septic system pumped. So there's expenses that come with all utilities, regardless of whether you're hooked up to the city. Now, another thing that people really need to look at before buying a home is what the market is looking like. And oftentimes this can be done just by speaking to a realtor or a lender or anybody who spends a significant amount of time in the housing market. When it's a seller's market, the sellers are going to have better deals. When it's a buyer's market, the buyers will get a better deal. That doesn't mean that you shouldn't buy just because it's a seller's market, but it does mean you need to be careful about what you're buying and what your intentions with that property are. For instance, and this is just my personal opinion, you're in a seller's market right now, and it is shifting towards a buyer's market, or at least that has been the trend. So if that continues, then the home prices may decrease slightly, they may stabilize, but don't buy it thinking that it's going to be like your great uncle Keith, who just bought a home in 2016 and now sold it for $100,000 to $200,000 more. It just doesn't work like that right now. What's going to wind up happening is maybe you'll get like a small standard increase, 2-3% year over year, but you're not going to buy it this year and then sell it next year for double the price. We had some crazy price increases going on between all the years of the pandemic up until this year, and things are looking like they're going to stabilize. Another piece of advice that I would give when you're looking at getting a home is to make sure you know what type of loan you want to get. There are different types of government-backed loans. They all have great incentives for each one. Stuff like conventional, when you hit 20% of your down payment, you get rid of what's called PMI, which could decrease your payment anywhere from $100 to $300 a month. If you're going FHA, you know that they have to meet certain requirements for that home to sell. With that being said, what you're going to run into is knowing that the home that you get is at least livable. Whereas conventional, you could wind up just getting a home that just has a functional bathroom, kitchen, and 1 bedroom, and the rest of the house could be a disaster. VA loans, these are loans that are only for veterans or spouses or dependents of veterans, which often people overlook. So the big benefit is you have a 0% down payment. And if you have a disability rating as a veteran, you get rid of a lot of those extra expenses as well. Another thing that I'd like to point out with VA loans that seems to be a common misconception, there is not one company that can do VA loans. USAA, Navy Federal, Veterans United. These are all popular veteran lenders, but you can go to any lender to get a VA loan. It could be your local credit union. It could be Chase Bank, Fifth Third Bank, any other lender, even a mortgage brokers, any of them can do VA loans. So don't limit yourself down to those specific people. Make sure you shop around for the best deal that fits what you're looking for, that you're working with somebody you're happy to be working with. Then you have what's called USDA or rural development. Now, USDA is a type of loan that is only available in specific areas. Now, these areas are meant to populate more suburban areas. So you're looking at more like farm towns or places that are really out of the way, but that could be a good way to get a very low down payment, or no down payment, I suppose in this case, with just your closing costs and move on. Now, another thing that I do want to point out is that often people are convinced they just have those closing costs. So if they find a program that offers 0% down, like the VA loan, rural development, and even sometimes conventional loans where they're able to get you 0% down and no PMI, you still have closing costs. And those closing costs average anywhere from 2 to 4% of the value of the home. Now, typically it's about 2%. But when you have a lot of these 0% down programs, a lot of times you'll wind up with more closing costs because you'll have lender fees tied in. So make sure that when you're looking at that, you talk to your lender and find out what that dollar amount is that you're going to be expected to come up with. Another thing that I'd like you guys to know when buying a home in 2023 is to know who you're working with. Make sure you're checking the reviews, make sure you're Googling them, looking at their business page, seeing what they're about, seeing what their experience is. Oftentimes, that's not just for the realtor, that's for the lender, that's for the title company. Everybody involved in your transaction, you want to know who you're working with. Make sure you're protecting yourself because nobody's going to look out for you more than you. All right. Well, that's it for today's video. Again, my contact info is popping up here on the screen. I'd love to help you out, and I'll catch you guys next time.